Many countries are assuming the reality of having to live with the COVID-19 virus through maintaining certain health protocols instead of actively fighting the virus through restricting economic activity. As such, in this new phase of the pandemic, global central banks and fiscal authorities are switching gears from rescuing the economy at any cost to beginning to normalize policy in the current economic recovery. The unprecedented cutting of interest rates and the expansion of balance sheets certainly averted a deeper and more prolonged economic downswing. But this has led to a stellar year of growth, with the International Monetary Fund forecasting an expansion in global growth of nearly 6% last year. Nevertheless, the pace of global recovery is set to decelerate. Relative to the March 2021 peak in global growth forecasts for this year, consensus estimates for growth have migrated lower in both developed and emerging economies. That said, the consensus still expects growth in the major regions to exceed their longer-term potential, despite the downside risks of less policy support, geopolitical conflict, additional more deadly variants of COVID-19, and a de-anchoring in inflation expectations. Moreover, chart 2 over here shows us that high-frequency data on global economic activity have surprised market forecasts in the last while, which should arrest the pace of downward revisions for expected growth for this year. One of the drivers behind the initial cuts to global growth forecasts was the imposition of renewed lockdown measures at the outset of the surge in the Omicron variant in early November last year. While this chart shows us that the average developed market tightened measures, the average emerging market tightened restrictions by far less, and many countries actually pushed to relax rules given Omicron's perceived milder level of infections. Moreover, post the pandemic, emerging markets have had far less monetary and fiscal ammunition available to combat the effects of a slowing economy, which has likely persuaded authorities to keep a lighter level of restrictions in place. Although developed markets have taken a higher level of precaution with their lockdown measures, the level of stringency was still far lower than in previous waves. This is partly owing to a higher level of vaccinations in the developed world, but also a shift in health regulations, including vaccination mandates, which allow for normal activity to resume, even in previously pandemic-stricken sectors, such as entertainment or even hospitality. For that reason, the latest tightening in lockdown restrictions has not affected mobility indicators as severely as what we've seen in previous waves. This has resulted in milder downward adjustments to growth estimates. The IMF has shown that major epidemics in the last 2 decades have been followed by periods of increasing inequality, and the degree of fiscal consolidation plays a very significant role in determining the extent of the rise. Given the size and the duration of policy support measures in developed markets, as well as a higher level of vaccination, output in these nations is anticipated to reach pre-pandemic levels a lot sooner. Amid this multi-speed economic recovery, emerging markets are likely to lag, particularly lower-income developing economies, which are likely to struggle for years with the after-effects of the pandemic. While initially low inflation gave emerging market central banks some room to cut domestic interest rates substantially and engage in unconventional policy, rising inflation risks have forced many to pivot towards an unwinding of ultra-accommodative policy even before developed markets have seen a lift-off in interest rates. On the fiscal front, economic relief measures added to the stockpile of government debt, with the average emerging market government experiencing a 10% rise in government debt levels since 2018. As such, with less fiscal room to support an ongoing recovery, output in emerging markets in aggregate is expected to reach pre-pandemic levels over a much longer time frame. This chart shows us that the output in the emerging market composite, with the exception of China, will still be more than 5% lower than pre-pandemic levels by the end of next year. The rate of vaccination continues to drive a wedge between the performance of higher income economies and that of poorer nations. Even though the globe is closing in on having administered nearly 10.7 billion vaccine doses, vaccination coverage remains highly unequal. More than 3/4 of those living in developed markets have received at least one vaccine dose. But this is in striking contrast to low-income economies, where only 12 people in every 100 have received one vaccine dose. Now, if this current pace of vaccination persists, only a third of the population in low-income economies will be inoculated by the end of next year. Possible new variants of the virus could leave even highly vaccinated countries at risk, and this could trigger renewed lockdowns. The IMF suggests that if manufactured vaccines had been equally distributed, the amount would have been sufficient to cover all healthcare workers and the elderly globally. Nevertheless, vaccine inequity has left a huge gap between the number of vaccines secured in the grey bars on this chart and the number that has actually been delivered in the blue stripes. This level of vaccine inequality gives rise to dangerous mutations in the COVID-19 virus that could raise vaccine ineffectiveness. This remains one of the major downside risks to global growth prospects in our view. Another key concern to the trajectory of the globe is stronger and longer-lasting inflation pressures. Inflation is running hot on persistent critical supply shortages and geopolitical pressures underpinning a surge in international oil prices. Energy prices are the key global transmission channel in Russia's assault on Ukraine. Higher energy inflation could squeeze real incomes further and could shave off more than 1/3% from global GDP, with the Eurozone experiencing a much harder hit than the US. As long as there are no permanent reductions to oil or grain supply, the surge in prices is likely to be short-lived. Additional structural damage could nevertheless trigger further significant upward revisions to inflation and downward revisions to growth. Other areas of the inflation basket have seen some reprieve. Despite goods inflation running at 5%, services inflation for the average OECD country has tracked at a far lower 2%. As the global economy recovers from the pandemic, demand should start to rotate from goods into services categories, allowing for goods inflation to start to return to more normalized levels. The Global Supply Chain Pressure Index, developed by the New York Fed, reached a new all-time high in November last year, but the latest data shows a tentative turnaround. One of the components of the index, the Baltic Dry Index, has fallen sharply in the past 2 months, suggesting a significant drop in shipping rates. In addition, Bloomberg reported that freight costs to send liquefied natural gas from the US to Europe turned negative for the first time in history in the middle of February, given the growing glut of ships ferrying American fuel. Inflation typically becomes more worrisome when workers in the jobs market respond to rising prices with demands for even greater wage increases, creating a wage price spiral. So far, this has not yet occurred, as can be seen in this chart. What's more is that accelerated investment in technology has boosted productivity, which can provide some offset to a rise in wages. In addition, longer-dated inflation expectations have remained reasonably well anchored in much of the developed world. Monetary policy authorities in developed markets are becoming concerned that cheap money has prevailed for too long. Stubbornly high price increases have further accelerated the pivot towards a quicker and sharper unwinding of ultra-accommodative monetary policy conditions. Nevertheless, with labor market dynamics and underlying inflation differing across the developed market composite, monetary policy responses are likely to diverge. In our opinion, a faster recovery in the economy and jobs market in the US and UK calls for more urgent action this year, while a lingering unemployment gap and benign underlying inflation in the Eurozone and Japan allow for a later liftoff in interest rates. With global authorities shifting gears from rescue to recovery, South Africa is following suit. But although SA experienced a notable rebound in economic activity off the back of previous stimulus measures, it is going to be much harder to sustain growth from here. Although faster than expected global growth, sustained commodity prices, a bounce back in pandemic-stricken sectors, or a faster timeline on reform could result in an upward revision to growth, we believe that downside risks still outweigh. Sustained high global inflation, spillover from the Chinese property sector, less accommodative policy locally, persistent energy supply constraints, and overarching structurally high unemployment continue to pose significant risks to local growth. Although tax revenue shortfalls were a recurrent theme in South Africa even before the pandemic, we were more recently gifted with a commodity price boon which lifted company taxes. This created room for an expansion of stimulus measures and an overrun in the government wage bill. Nevertheless, the windfall gains from commodity prices are unlikely to last forever, and a sudden correction in commodity prices could threaten the funding for any permanent expenditure outlays. Therefore, while favorable commodity prices have brightened the near-term outlook, we maintain a more cautious stance in the medium to longer term. In particular, three major risks cloud the outlook for government's fiscal consolidation efforts. These include restraint on the civil servant wage bill, having to meet rising social demands to address crippling inequality, and further assistance to ailing state-owned enterprises. A faster than anticipated recovery from the pandemic and a positive surprise on South Africa's near-term fiscal and debt metrics should stave off any negative rating actions this year. However, we remain concerned about the outlook for the sovereign rating further out. Years of tepid growth have translated into weak progress in improving living standards for all South Africans. With trend growth hamstrung by infrastructure bottlenecks, unnecessary red tape, and policy uncertainty, the IMF shows that SA is likely to underperform the bottom quartile of countries in the next few years. The Fund for Peace shows that the Fragile States Index improved for South Africa in the last 3 readings, but there has been an overall negative trend in the last decade. From the underlying data, it is apparent that security, the state of the SA economy, and public services are contributing to a high level of fragility. SA has seen the largest deterioration in the security score in the past decade, implying greater distrust in domestic security, more organized crime, and a higher risk of violent uprisings. In a similar vein, the index measuring the state of the economy has deteriorated significantly in the past decade, shifting the country from the worst position in its selected peer group. In our view, these challenges are unlikely to be met with an overnight fix and will continue to burden the sovereign rating in the medium to longer term. Should SA underperform its peers as expected, the bias to the rand remains weaker. Nevertheless, the pass-through from the currency into the consumer basket remains relatively muted, so much so that South Africa experienced somewhat an atypical response in this latest surge in global inflation. While headline inflation in developed and emerging markets spiked to levels significantly higher than their longer-term averages, this chart shows that the recent moves in inflation locally do not appear out of kilter with the longer-term historic trends. We also expect low services inflation, weak demand, and anchored expectations to keep inflation well within the target range in the medium term. Therefore, in our view, although we expect up to at least 3 interest rate hikes of 25 basis points each this year and a terminal rate of below 6% in the cycle, stable inflation expectations and a high level of central bank credibility are expected to stave off a higher interest rate profile. In summary, although global growth expectations have softened, forecasts remain well above trend. Nevertheless, downside risks to the economic recovery have not disappeared. As long as rates of vaccination remain low in poorer economies, the risk of more virulent forms of COVID-19 remain a threat. Moreover, geopolitical tensions and sustained supply chain bottlenecks are likely to keep inflation higher for longer, and this is expected to result in a front-loading of central bank tightening from a very ultra-accommodative position. Fortunately, in South Africa, local inflation is expected to remain contained on idiosyncratic factors, and as such, this lowers the risk of significantly tighter interest rates relative to our own forecasts. Thank you for your time today.